have a much higher level of volatility, and you have cross currents going in all the time. And so what we think is active management, changing your stance based on where we are in that credit cycle is going to be hugely important over the next 10 years. And again, if you're indexing over the next 10, you might get an okay return, but it's going to be muted versus somebody who's actively moving around and catching the allocation correctly. Okay, so what's interesting about indexing? Okay, so we're talking about indexing. Indexing, you need a high liquid market for it to work very well, i.e., S&P 500. Passively indexing into the S&P 500 is easy because you have lots of shares trading all the time. It's very liquid. So you can do that. When we start talking about corporate bonds or muni bonds or any kind of bonds except treasuries, treasury market's fairly liquid. You can actually index into the treasury market. What happens is we're still an old school business. We're still talking to brokers on the phone. People still make inventories of bonds. And so you have essentially lack of liquidity. And so if I try to passively index something that has low liquidity, you have a problem with what they call your creation and redemption units in an ETF.